So today I'll be talking about those types of liquidity. I'll be talking about them. Now, first of all, you ask yourself, what is liquidity? What is liquidity? Liquidity. Now, look at liquidity as a basket that is supposed to contain a certain number of items, right? Looking at it, there are no items in that basket, but definitely in the future you're going to fill it up with the required items, right? That is liquidity. Liquidity is an unfilled order in the market that market will eventually move to fill up, right? Liquidity is an unfilled order in the market where market has the potential to go back and fill, right? This is a space in the chart where more buyers or more sellers drive the market, creating an unfilled order, right? Orders that are meant to be filled but couldn't be filled because of the high drive of buyers or high drive of sellers at a particular time, right? That is liquidity. Unfilled orders in the market. Simply, liquidity is money, right? Liquidity is money. Liquidity is the money in the market, right? Simply, liquidity is money in the market. But for you to understand what liquidity is an unfilled order in the market where markets will eventually go back to fill up. Right now, what are the types of liquidity? What are the types of liquidity? Since we know what liquidity is, what are the types of what liquidity? Now we have the equal high and equal low. We have the FVG. We have the fail to break liquidity. We have the fail to close liquidity. Equal high and equal low can also be swing high and swing low, right? The fair value gaps, which is the FVG, the fail to break and the fail to close. We also have the trend line liquidity. Now all these are grouped, right? All these are grouped into different categories, right? Now these are just the types. Now what are the groups? What are the group categories rather of liquidity? What are the categories of liquidity? Number one, we have internal liquidity. We have external liquidity. Good. Now, in the internal liquidity, we have the fair value gaps, the fail to break, the fail to close liquidity, right? And in the external liquidity, we have the equal high and equal low. We have the trend line liquidity. We have the session liquidity. We have the daily. Okay, let's leave the daily. The daily also resides in the equal high and equal low. So let's look at the fair value gaps, the fail to break, the fail to close, the equal highs and equal low, the trend line liquidity, and the session liquidity. Now, I'm going to demonstrate all of this in the chart. So all these are liquidities we can find in the market, right? These are liquidities we can find on a chart. First of all, we understand what liquidity is, right? An on-field order in the market. Market will just know that a point of liquidity will always attract the market, right? Now, this is my chart, right? Sorry, it's very messy due to some analysis I've been doing. So this is my chart. Let's move down to the 4-hour time frame. Now, this is the 4-hour time frame, right? Let's go down to the 30 minutes. This is my 30 minutes time frame. Now, if you want to get a clearer view of your chart, hold alternative on your keyboard and tap on arrow. You're going to have a much more clearer view of your chart, right? As you can see, I have some sections enabled, right? You can see the New York section, you can see the Sydney, Tokyo, you can see the London section. They are all activated here. Now, for you to do same, you have to go to your indicators. You have to go to your indicators and search for market section by Leviathan. This is it. Add it to your favorite, right? Once you tap on it, it is going to be displayed here. Look at it. Look at market section by Leviathan, Tokyo, London, New York, Sydney, section high, low, UTC 1 dash normal. You can hide it, you can activate it, you can set the timings. You set the timings here. This is my timing. You can set it, you can delete it, you can get the source code, you can do more of this here. You can remove from here, get the settings, move it, visual order, get an alert. You can add an alert here, right? So looking at this, right? let's talk about the liquidity, right? Let's talk about liquidity here. Let's talk about liquidity. Now, we said liquidity is grouped into two, right? External and internal liquidity. Now, we said the internal liquidities are liquidities found within a buying or a selling range, right? Like the fair value gap, the fail to break liquidity, and the fail to close liquidity, right? Now, looking at this chart over here, first of all, the fair value gap. The fair value gap is usually found around a space. It is a space, or the space between three buying or selling candles. It is the space between three buying or selling candles. Now note, it can be between three mixed candle. Let's say the first candle is a buying candle, the second candle is a selling candle, and the third candle is a selling candle, and you have a space between these three candles. It is also known as a fair value gap, right? Look at this spot here. Let me take this out. Now you can see that there is a space from here to this point. There is a space from this point to this point. Look at other candles. Look at other candles. You see that there are no space here, no space here, no space here. There is a space here, but this red candle came back and filled the space. Are you seeing it? This red candle immediately came back to fill this space. That is liquidity, right? Once you see something like this, just know that market will eventually come back to fill this spot. Market will eventually come back to fill this spot. In this case, market came here, rejected, went back to fill this spot, right, and start going down. Market start going down, and market is now going back to this spot, this particular region here. This region, this is a region of liquidity because there are unfilled order here, so market must come back to tap on this unfilled order here. You can see market is going up at this spot before market closed on Friday. Market is about to hit this liquidity, right? So that is for the fair value gap. Now the fair value gap is an essential point one need to take note, because once market sweeps such liquidity, market will always reverse, either in a short term or in a long term, right? Market will hit such liquidity and reverse. That is for the fair value gap. This is a fair value gap here. This is a fair value gap here. This is a fair value gap here. This is also a fair. You can see this fair value gap was refilled here. These two candle came to refill. After refilling, after the green candle refilled, there was an engulfing candle. This is an engulfing candle, right? It continued the downtrend. After refilling, it reversed and went down. Look at this fair value gap here. It refilled and reversed again, went down. Look at this fair value gap here. Look at this fair value gap here. It refilled at this spot and started going down for a short term, came back, tapped here, and start going down. Now you see that there is a fair value gap here, you see, which was unfilled at this point, but taking it to this point. Look at this point. Just take a look at this point, this highest point here. Market came here, refilled this fair value gap, and start going down again for a short time. So the idea on this short retracement is to give money to scalpers, right? At this point, scalpers will make some few cash. At this point, scalpers will make some few cash. At this point, scalpers will make some few cash, right? Those who usually flip accounts will make some few cash at this point. This point, this point, this point, this point, even this point here. they should enter at the beginning of this point. They will make some few cash down even to this point here. Here too, flippers will make a few bucks here. So let's move over to the next liquidity, right? Now, when there's a space, looking at this 3 candle, like I said, when there's a space between the first and the third lying on the second candle, the space should lie on the second candle, then that space is known as fair value gap, right? Now let's look at fail to break liquidity. When you observe that market is always getting to a point and retracing, always getting to a point and retracing, and market is not breaking above that point, right? That point is a liquidity zone and it's called fail to break, right? Because market has not broken that liquidity. Look at this point and look at this point, right? And look at this point also. 1, 2, 3. This point is known as a liquidity zone because market has not broken this line, right? It is a fail to break liquidity. This line here, this green line here, represents the fail to break liquidity points because market is not breaking this point. Why is market not breaking this point? Since market is not breaking this point, it will always attract market to clear off all this liquidity here, which in this case market has cleared this liquidity line. Look at this is an IFC candle. Subsequently I'm going to explain what IFC candle is. This particular bearish candle broke this trend line. It broke this liquidity line, rather it broke this liquidity line, so it has broken the liquidity. But from this point, this is a fail to break liquidity, right? It is a fail to break liquidity. So I can wait for market to sweep this liquidity here, all this liquidity here. I can wait for market to sweep it. Market swept it at this point. Market also swept it at this point. At this point here, market also swept at this point. After sweeping, after all these sweeps, I can decide to enter a buy depending on my strategy, because I know that market has swept this fail to break liquidity here, right? That is that for fail to break. Now fail to close liquidity. If you check at this point, this candle that broke this fail to break liquidities, this candle that broke it, it created a fail to close liquidity. You see, it only gave out a wick. Market, this candle did not close with a full body here. This candle did not break this liquidity with a full body. Look at this other candle. This candle broke the liquidity with a full candle body. Are you seeing it? Before shooting out the wick. This small long thing here is the wick, while the body is the candle. This candle here broke this failed to close liquidity with a full candle body. So this particular candle cost, this particular candle here caused a fail to close liquidity because it refused to close with a full candle body to sweep the fail to break liquidity, right? So it is a fail to close. It failed to close, so it failed to close, so it resulted in creating another liquidity here called the fail to close liquidity. So I've been able to explain what the fair value gap is, what the fail to break liquidity is, and what the fail to close liquidity is. So since I have a fail to close liquidity, I know that market will still come. Market must come back here to sweep this liquidity with a full candle body, which is what market did here. Market swept it with a full candle body. It didn't sweep it with a wick. Hello, this small thing here is a wick. This long line here is the wick. Market did not sweep this other fail to close liquidity with a wick. It swept it with a full candle body, right? So at this point, I know that market wants to reverse because it has swept all the liquidity, both the fail to close and the fail to break. The fail to close here swept the fail to break 1, 2, 3 with the wick, right? So it created a fail to close liquidity because it couldn't sweep the fail to break liquidity with a full candle body. Then I know that another candle will come here to sweep this fail to close liquidity with a full candle body. So I should be waiting for that. So after seeing that, I know the next thing is a reversal, which is what is happening here. So let's move on to the next, external liquidities. All right, so the external liquidity. Now let's go to a much more higher time frame, say the 1 hour time frame. Now let's go to 4 hours time frame. Good. Now the external liquidities are majorly found on higher time frames because it gives you the overall look of the market. So going down to our 4 hour time frame, a lot of liquidities are visible here. A lot of liquidity are visible here. Majorly the external. There are internal liquidities, yes, on the higher time frame, but it is much more effective, it is much more valid on the lower time frame. That is for internal liquidities. They are much more valid on the lower time frame, while the external liquidities are much more valid on the higher time frame. So look at this time frame now. Look at this 4 hour time frame. Look at this. You can see that there are swing highs here. Look at this point here. One, let me delete this box. Look at 1, 2 and 3. These are swing highs because these are the highest point market got to before reversing. Market got to this point, reversed, got to this same point again and reversed. So these 2 points are equal highs because market at this second reversal here, market went to the same spot as the previous high. Look at the previous high here. Market came down, went and tapped on that same spot. Are you seeing it? Market tapped on that same spot. So this is an equal high liquidity. These two here, there are equal highs, right? There are equal highs liquidity. Then look at this spot. Sorry for that. Now look at this point here. These are equal low. Market tapped on this low point, got up again to create an equal high, came back again to that same point as the previous low and went up again. So this is an equal low liquidity. 1, 2, equal low. I can, after seeing this low here and this high, I can just wait for market to tap on this low, which is this previous low. I created a PO, like an indicator. I created a box here to tag as my POI because I was waiting for market to come back to this same low, which market did and reversed. Are you seeing it? So this is an equal low, right? This is the first low. It came back and created another low. So these are equal low and these are equal high. Are you seeing it? In demand and supply, this liquidity is paramount in demand and supply. This type of liquidity is like the base. It is like the deal of the day in demand and supply, right? Equal highs and equal lows, right? Now, having established that, I'll stop here. Now let's look at section liquidity, right? Let me go over to the low time frame. Good. Section liquidity. Now you see we have the London. For the section liquidity, you have to activate your market section, which I explained earlier in this video. You have to activate your market section. After activating your market section, you're going to see that this is New York and this is London section. Now you see that New York, London section created a liquidity at this point. Let me zoom so you see. Now, looking at this point, London created a liquidity here. It also created a liquidity here, right? Now, the New York section started off as a sweep. Now, this is the liquidity London section. This is the highest point London section began with, right? This is the highest point it began with. Now, during this London section, no other candle was able to break this highest point, right? So this is a liquidity. But at the start of the New York section, this candle here broke this London section. So after this New York section has broken this London section, the next thing I should be waiting for is a reversal pattern. You can see after sweeping this London section, it came down, right? First thing you need to understand is, once there is a sweep of liquidity, there is always a reversal. Once liquidity has been swept, there must be a reversal, right? Once liquidity has been swept, the next thing you should look for is a reversal pattern. That's why I will always advise traders to learn candlestick patterns, so you know which pattern is a reversal pattern or a continuation pattern, right? So after New York section has swept this London section, it reversed. So this liquidity here is known as section liquidity for London. Is the highest point, and this liquidity here is known as the section liquidity for also London, right? Okay, sorry, this liquidity here, I didn't see that. The liquidity that began the London section created a highest point and a lower point. So this is also a liquidity. This is also a liquidity. But the New York section began and broke out the London section. Now, there are some liquidities that are not valid, if I should use that word, meaning even if market swept that liquidity, market will not reverse, right? Market will keep going. These liquidities are not valid. That is why it's important to understand candlestick pattern, so that when liquidity has been swept, you know if what you're seeing is a reversal pattern, right? So liquidity, New York section swept London section at this point. So this point here is a section liquidity for London. This point here is a section liquidity for New York. You see, the highest points market get to in each section is known as the section liquidity. I believe that's cleared. So always watch out for the liquidities.